Alright, hello guys, and glad to have you on board again today. We are Wednesday, and even though this is a new trading season that just got started, we're not going to change anything. I thought it was worth it to keep on having the same schedule. So every Wednesday, just like we used to do last year, we're going to keep doing these flow trading time frame reviews. TLDR in here is that as this is the first of the new trading year, so-called, we're going to review all the nitty-gritty details about it, all the basics and standards to apply these strategy consistently and efficiently if you're intending to do such a thing. The number one thing that I wanted to talk about first as a kind of an introduction is that I'd like to mention the general mistake that people tend to have when they go around trading on the first years of their experience. Once again, I'm talking about my own personal experience here, but the one that I've seen replicated multiple times into other persons. So the thing is that we're all attracted by the short-term trading for whatever reason, generally some personal things, but this generally orchestrates around the same stuff. We're all very, very sensitive to two factors, the fear of uncertainty and the impatience biases. Though that means what generally tends to be driving any normally constituted human being to shorter time frames is the apparent removal of these two things. That means you're actually under the influence of those two biases, and in order to make them like less fluent, you're going to be going into shorter time frames in which you think you can control uncertainty because you have that kind of casino effect, which is to me basically that you're going to get a faster answer after you've taken the bet. So the weight of waiting and not knowing it's just easier to handle. On the second hand, well, the impatience biases plays as well because of this. That means you will have less uncertainty to bury in terms of time duration. The uncertainty will last less longer in shorter time frames, but it's also going to be faster to trigger the action. That means there is more action. That's what many people want. They have that false sense of and feeling that the more you trade, the more profitable you are, which is an entirely full of shit kind of illusion. But we'll come down to this one later. So I wanted to mention that one, okay? Remember that if you were thinking about trading in shorter time frames as, okay, I can pick and choose the time frame which you trade on and therefore not giving a fuck about what happens in the higher time frames, well, you get it absolutely wrong. And that's the number one mistake that I see being done all over the place. I'd done it back then as well. So the reason why I'm doing these educational series and stuff like that is not to say, yeah, listen to me, I know how to do it, just do like I do and stuff like that. No, it's just I've made several mistakes in the process, and you're probably going to be doing the same as well. So try to learn from my personal experience. That would just make your own experience probably a bit faster and eventually less painful than mine, okay? Because the road to success is definitely not as easy as people tend to tell you on the YouTube channels and the like, okay? Trading is a very, very fucking complicated job. Very few of us will succeed, and the vast majority, 98% of so are just ended up either not making money or very tiny amounts of money or just losing. So that's really the way it goes, okay? I'd like to make it easy on you guys, but it isn't, okay? So while if you've gone this path of trying to short-term trade by just not even acknowledging whatever happens in the high time frames, because whenever people talk about it, it seems way too complex and stuff like that. Let me tell you, very straightforward, you got it wrong, and you're going to painfully learn it the hard way, okay? So generally speaking, if you want to trade the shorter time frames, you're gonna have, whether you like it or not, to study the long time frame first. It only goes one way. You have to assess the longer time frame low risk strategies, and only then you will be able to scroll down to shorter time frames to trade flows or even just plain volatility, okay? I'll give you strategies to do this, and these strategies are not magic. They don't predict the market. The market remains uncertain at all costs, but the thing is that in the end, out of 100 trades following these rules, there's no way you can lose money. It's just the way it goes, okay? It's a positive expectation of, damn it, what's the fucking word in English? Well, I can hardly find it. I mean, expectancy, or I would say, yeah, the expectancy of reward. It just means The longer you play the experience, it's just a statistical way. In here, the longer you trade, the more statistically relevant the strategy goes, and it can't lose money the more you trade. That doesn't guarantee that one trade will win or lose. It's just really the way it goes. It's just like throwing dices. There's no way you can predict the next dice's number unless you throw it 1,000 times, and this is really the way it goes. Okay, out of 1,000 times, you know the distribution is very much heading into equally weighted. That's the way it goes. Okay, the strategy is nothing more than that. It's just a set of rules that, so long as you play with them without bending any of the rules, will give you, out of 100 or 1,000 trades, a positive expectation of return, and can't be the other way around. It's just like a bias, a shift. Okay, it's no magic trick. It's just that, of course, try to bend the rules, make mistakes, and you will destroy this thing. So that's really the way it goes. Okay, so starting all over the place, this is the model that we're going to use all across the board, each and every Wednesday. That's the basic. That's the strategy. Okay, for low risk actual flow trading. Okay, so that's what it goes. Like I said, the number one step, and you never want to be missing that one, that's the general mistake that you guys do in the first place, is to forget that there's no flow trading sequence to exist when there hasn't been a positive reaction out of a low risk area. The low risk area is 3 time frames above the one you're going to be trading on. Okay, that means that first of all, you're going to have to learn the strategy. Okay, you're going to have to figure out a way to define those low risk area. I goddamn don't care how you do it. Okay, that means first of all, you can use my strategy or any other out there. You have to have a clear set of rules that define how you figure out those low risk areas. Okay, once you figured out one out, you're going to go 3 time frames below. Quick example in here, I'm going to take the S&P 500. That's the one we have a look at in a regular basis each and every Wednesday, among others, of course, but that's the one that's the most interesting at the moment. Okay, so how to figure out these things? Well, you got a set of rules. I'm not going to go down this road in here. It's just to say, well, out of this, we have a bullish trend on even higher time frames and so on. And we had kind of a reverse in here, back to the support context. So we had the end of a cycle, TLDR in here. That's a bullish opportunity. That means there is a bullish supportive context in here. All right, so that was the number one rule to say. Okay, if you don't have either my indicators or any other strategy out there, I don't really care. Just all that matters is you should have a clear set of rules that highlight this area as being an important area. Okay, the reasons you use to get there, I don't mind, but they have to be hard coded. They're not just, yeah, I think the area is here, or I feel like it's here. It's just, you gotta get me a clear set of rules that define this area and no other particular area. Okay, so the way it goes. So now that you know that there is a supportive area in here, which reference time frame it was upon, okay? To me, that's the weekly chart that gives me the support channel, okay? So in that sense, I'm going to go 3 time frames below, and this is where I'm going to get my flow sequence, okay? That's really a simple thing, okay? So now that you get it, you will say, yeah, now we're in the opposite area. We're in this kind of selling area, Phil, okay? And I would say, great job. This is exactly what we're in. We've gone out from the bullish area. We've rebounded, though that means a bullish sequence of flow has started in here, and we followed it through all year long for the previous season. And now we're in the resistance area. That means those who want to sell have their turn now. So it's really the way it goes. You take on this pattern and you reverse it. We're in a low risk selling area. So that means you can trade bearish flows now. One thing that you really need to notice in here is that, remember the longer term trends, okay? The very low risk context is still bullish, okay? And it goes to monthly secular trends that are still intact at the time. So you'd rather like to assess that. You can definitely trade against the low risk trend. That doesn't guarantee you'll succeed or whatever. It just says, I have one rule. When you trade against the trend, you rather like to be lowering the risk you take. That means the strategy is clear upon that. You cannot take any more than 2% risks per trade. That's really the way it goes. Okay, so of course, if you want to take the maximum 2% risk per trade on this strategy, well, that's up to you to decide. Otherwise, I would personally say when you trade against the trend, try to lower that barrier. And to say you have the option to go below 2%. So I would say a rational in here would be somewhere around 1 to 1.5%, but something lower to 2, just because you're trading against the major trend. Okay, so that's really the way it goes. Back to 1 hour. and we're going to look at our sequence. So our sequence says, okay, same story, you get to the lowest carrier, just reverse this thing, okay? And the first stage isn't, okay, I sell. No. Okay, the first stage is the context needs to go outside the average, as the moving average needs to be slightly positive, or in our case, negative. Or flat, but doesn't have to be going on the opposite direction. Okay, there's a clear set of rules. I mean, these are things that either validates or don't. So it's really the easiest way. Then it's followed by a third range boundary. Okay, third range boundary is just with my thing breaking the context channel. So that's really as simple as it is. And then you will buy. Okay, this is the buy entry on the moving average of the Bollinger Band. Okay, that doesn't guarantee you're going to buy at the low. It's just you're going to buy in an area close to the moving average or the Bollinger Bands, pure and simply. Of course, you can spice it up with some technical signals and stuff like that to try getting the best possible entry price, but that's really all it is. You're going to trade near that goddamn moving average, okay? So here's what we have. Taking on from this pattern, so this is our bearish low risk area. We've gone into this. We sold out of it. We see the moving average getting out of the context, so we definitely have our first step in here, okay? Next is we wait for a third range boundary. Bam, bam, okay, here we got it. Okay, so that's stage 2. That means now we're ready to trade. Though there was one area to trade, the moving average, remember, got totally fucked up, broken through. And now we've got the Bollinger Band. Okay, so that's really the way it goes. So that's the reason why I got to sell in here. Remember, close to the Bollinger Band and stuff like that. Now, as you would notice, the Bollinger Band hasn't been touched perfectly now. The Bollinger Band still stands in here, okay? This is standard 2.0 deviation, though in here we're at 45.53. That means, normally, I still should be waiting for this trade to trigger. Okay, the reason why I've entered this one is because I was in front of the computer at that time and I got to trade manually. Okay, but otherwise, this is how we do it. I would still have that area in here with a limit order just waiting to be filled. That's where the way it goes. And there are two options out of this. Either the market goes up to fill your trade or doesn't. But that's just how it goes. You don't control anything. The market dictates the rules, you just adapt. You just know what next step is yours, and you goddamn don't know if the market is ever going to go there, and if it does, you don't know when. And you're gonna have to embrace these two things. Remember, they are just the exact opposite of what you hate the most. This is exactly the facing realities of your uncertainty and impatience biases. You will never know if the market will be there to catch you or not. You'll never know when it will do it, and you're gonna have to accept that. Okay, so that's really as simple as it is. I've taken this trade manually, and now I think, well, it's close enough to the Bollinger Band, so I'm going to keep it. Okay, and on the other hand, well, if it goes higher, I'm going to reinforce. Of course, in here, I've taken a slightly higher trade than if I did get to touch the Bollinger Band. Okay, basically in here, it's a 0.5% risk, and I will take another 0.5% risk if it goes to the Bollinger Band. Overall net, I will have two positions combining for a 1% risk. One that has been taken manually, the second one that will be triggered probably by a limit order, which is standing exactly at the Bollinger Band. That's where the way goes, okay? Clear, simple set of rules. I follow the market. I doesn't dictate the rules. I just learn the things and I repeat. It's a really stupid way of trading. But, I mean, like I said, you want to trade short term, don't overthink things. But you certainly can't avoid figuring out what happens in the higher time frames. Because once again, I do trade 1 hour because we're in a weekly context. If we enter and switch the monthly context, then that means I'm not going to trade 1 hour charts. I'm going to trade 4 hour charts instead. And that's the reason why many people make mistakes. They tend to trade the time frames they like. So that's not how it goes. I trade the markets due to the time frames that it gives me. And that's really significant difference. Okay? Okay, that aside, so you now have a selling entry in here. The target is pretty damn simple. The model says it all. Okay, just follow through. Next stage is that I should get this, which is breaking the previous market top, or in our case, previous bottom, which will move my trade to stop loss at break even. Okay, until then, the stop is defined by the risk management of this position. That's the trend channel size, and the maximum stop loss is the previous low, because of course the sequence must maintain higher highs and higher lows. Okay, you never break the previous low, otherwise that's just the sequence is over. Okay, so that's pretty damn simple. That means for those who trade here, the maximum stop loss is there, and generally speaking, you would like to take not necessarily this entire stop loss. I think personally in here, my stop loss should be somewhere like there. Okay, so that's really the way it goes. Okay, maximum stop loss is there, and the whole sequence is fucked up if we ever go to new highs. Okay, so that's where the way it goes. The validation, there's none. The thing is that the stop loss will be set at break even only and only if and only when we break 43.58. That means until then, well, it can be done in a couple of days, or it can just never happen, or take several weeks to get there. You goddamn don't know, and there's no chance I can give you that answer either. And I'm totally fine with that. Okay, so that's the way it goes. Don't control things. Okay. That's really the way it goes. All I know now is what I've done, the reasons why I'll do it. I also know my next move if this happens, and I also know my next move if things go down. And until then, whatever happens in between is none of my concern. Okay? Very important stuff for you to get through. Well, now on the other hand, there's one thing that I'd like to mention, because it's important for those who've been looking at this thing before, and particularly last week, who would notice that, well, sorry, let me just get rid of this. It's just that, well, this doesn't require anymore as well. Okay, let's just get things clean. Remember that we've gone out of a supportive area, this one in the side of the trend and so on. That means there has been some kind of bullish flows leading us to that selling area. Remember, for those who've been doing this with me last year, we've highlighted the whole sequence itself. It's just following the same set of rules, okay? Not if nothing is invented. Though we've had a massive low risk area in here, the weekly supports. We've made the first flow in here. I just moved one time frame higher so you guys can see the bigger picture, okay? So, but in here, the context of moved above the moving average, which was rising or slightly flat. Okay, then we've got the consolidation, the third range boundary entered in here, the moving average got paid in here, second flow triggered. Okay, second flow terminated at some point and somehow found its way into retracing to the Bollinger Band, which I bought. Okay, bought the Bollinger Band, and remember this area was very particularly complex to navigate psychologically speaking. But the stops anyway were below that level. Remember, the same story. Then the third flow somehow triggered. It was very short-lived, as it barely managed to break the previous highs before it reversed its course. So very, very tiny and tricky flow to navigate. Then came the two sets of consecutive flows. That's what I'm mentioning here. Remember, after a set of 3 flows, 1, 2, 3, 4, 5, you're going to have to let go 2 consecutive flows. Okay, that needs 2 times in which the prices will fall below the moving average. Okay, so that was happening here. Back then you still have the records. It was pretty damn complicated to figure out the technical structure, because we had hella lot of volatility alerts in here, which very much played around with time and mentality, and it was very hard to clearly validate the rules. We had to bend a lot of rules back then and say, okay, uncertainty is definitely at play, so we're just going to step back and let the market give us the answer while still following a bullish bias. Because of course, one thing for sure, if the odds are 50-50, the market will generally tend to follow the larger time frames. So that means, well, if there is a secular bullish trend, you rather like on a 50-50 chance, when you can't separate the two, you rather like to choose the one that's following the trend. That's just where it goes. Okay, so I kept the bullish bias back then, and that's really what it goes. First flow triggered. Okay, it wasn't very staggeringly bullish, but that's the way it goes. Then third range boundary, but the Bollinger Band, okay, pretty simple and straightforward. Second flow tend to trigger. This one was pretty damn rewarding. Closed the profit takings in here, and now here we are. As you can see, I haven't sold at the high. Okay, some people tend to tell you, oh, I'm always buying at the lows and selling at the high. I'm full of shit. In here, my rules just told me, okay, take your profits in here and you're done. Okay, so this is what happened. Took my profits. And the market did go higher, no big deal. Okay, and now we're still, well, that was a nice, pretty damn nice second flow. So now it's time for the third flow. So remember what that goes. That means I want a third range boundary, which we hardly managed to get back there. Okay, so third range boundary, we're actually doing it now. That means normally I should be buying the Bollinger Band. Remember, the sequence of flow goes by 3. 1, 2, 3. So there's still the possibility of a third bullish flow. So how the heck do I navigate this? Well, remember what we just said earlier. There's everything required for a bearish flow to trigger. But in here, the bullish version of this equation just says we should have one more flow to go. So how do you process all this information? Well, that depends on you. On here, I have no magical answers. It just depends on a trader-to-trader basis. Both these trades validate the rules. Really, clearly. We have a third range boundary. I got them willingly going to buy this area. So the sell trade is supposed to be validating and putting at break even by breaking the low points. But on the other hand, I'll probably get a buying entry right before that. So Well, that's conflicting elements. So that tells me one thing. The market's going to have to pick one of them, potentially could even validate both of them. That means I could still get to enter here, break the previous low, make some profits, and still not being stopped out from this trade. Because remember, there is a risk limitation. There is a stop loss. I'll be able to absorb some volatility out there. So that's really the way it goes. You can actually turn out to be proven right on both ends. All that matters is you never bending the rules. When the rule is validated, you can take the trade. And of course, if you're willing to pick just one of these two trades, preferable to your own choices, that's up to you. If you have a bearish bias and think the market will go lower and don't want to take the bull trade and only take the bear trade, well, that's fine to me. As long as you respect the rules, I would say, okay, that's fine. You have a positive expectancy of return over time. This is the way it goes. The more you trade, the more you validate the strategy. That's the way it goes. So to me, I see two opportunities. I'll take them both. And that's the way it goes. That's the way I see the market. And you might see it differently. You might have a bullish or bearish bias direction. The other way I would advise is to say, well, remember, the secular bullish trend is at play. So if you trade both, don't trade them both with the full leverage. I would say, just like I said earlier, I'm taking the bear trades with a slightly lower leverage than the bull trades that I will take. That's the way it goes. Okay? You can decide to pick just one of them. If you're fully bullish, you're going to say, no, I'm not trading counter trend, whatever. All of this is doable. It just depends on every personal risk assessment for every trader. Every one of us is going to be different, remember. But if you don't have a clear set of rules, it's just not going to make it. That's really the way it goes. The sets of rules that are black and white rules that doesn't take any personal assumptions into account, that's what makes the difference with a sustainable winning trader and somebody who's just relying on luck or anything else. So that's really the way it goes. I hope you've learned something useful today. Remember, my strategy isn't the winning only strategy out there. There's so many others that are profitable strategy. What matters the most is just how consistently you're able to use them. Of course, a good strategy implicates several numbers of rules. It scrolls across multiple time frames. Remember, the shittiest strategy is the one like, yeah, when the moving average crosses this, that's that, buy, sell. That's full of shit, okay? A set of rules has to be at least a bare minimum of complication because, well, rules that just stands in four rules is not going to make it, okay? So strategies that actually work are not necessarily crazy complicated. Just like I said, I think I could teach that to my kid and he will be able to figure it out very quickly. So honestly, it doesn't have to be extremely complicated, but it certainly can't be just as easy as people make it, okay? That's how it goes. It takes some time to process, takes some time to learn it, but it's definitely doable. Anyway, just like I said earlier, we're going to keep on doing this thing every Wednesday, just like we did last year and so on. And the rules are what they are. I don't change the rules, and you're going to see it by yourself, applying it, repeating it over again. The last question I would like to assess is that, well, is this a strategy that's working just with the S&P 500? I'm using it in front of you every Wednesday, and we're going to update it over time to show you how I navigate this thing. And I use the S&P 500 and a couple of other assets for a simple reason. I'm not an analyst. I talk about what I trade. Every fucking thing that I'm talking in here, I put money where my mouth is. So that's really the way it goes, okay? I hate to trade. I hate to talk about something that I don't trade. And I have very little respect for people doing it. So on that end, that means, well, I don't cover the whole extent of the market. There are opportunities everywhere out there. I'm just talking about the ones that I actually trade, and I use that. And I do have some other trades that I don't mention, but the thing is, really, that's the way it goes, okay? I'm going to use this as an educational content support. That I'm using this one as a reference for consistency. So there will always be the S&P 500, sometimes some other assets which we're going to follow the flows. What matters is you don't go down this path of saying, yeah, okay, I don't have to process all this thing. I'm just going to copy the guy. He seems competent enough. Just don't do it, please, okay? So what matters to me is not you just copying me or liking or not liking me. I don't give a fuck about that. What I'd like you to do instead is to try using this thing yourself. Trying to test it, back test it, look at historical data, replay, show for yourself that it works, and then apply it elsewhere. Don't just stick to the S&P 500 and do like I do. What matters is you learning the process, repeating it, and getting ahead of being a self-fulfilled profitable trader. That's all that matters to me, okay? I don't want you to be like me. I don't want you to trade like me. I want you to just learn what makes a trader, and that's it. And there are no many ways around that thing. You can replace the rules. The rules are dependent for every trader, but the set of rules that we all have tend to be freakingly similar. So, like I've always said, you can change whatever I've used, like the context and whatever, to any other potential type strategy standing out there. All that matters is that the level of complexity should be somewhat similar, okay? Simple rules generally make very little returns, and they generally tend to provide more certainties than anything else. And that's the last thing that I'll address before leaving you guys. Remember one thing: if you're in here to be proven right, you're wrong place. Okay, most of the traders that I know, they don't make 90% positive trades or whatever shit that is. Or otherwise, if they do it, that means they do it with a negative risk-reward ratio. That means they're risking more than they're gaining in the trade. That's something that I don't advise to do ever. I'd rather like you to be 50% proven right or wrong, okay? So that means half of the time you're wrong, and you're gonna have to deal with it. But when you gain more than when you lose. And that's just as simple as it is. If you can strike 50% success rate with a superior to 1 to risk-reward ratio, you're just making money. So that's the way it goes. The more you trade, the more you will make that money. And that's just as easy as it is to me. Take away this factor of being right or wrong. If that's how you study a profitable trader against a loser trader, that certainly isn't a success rate. Somebody that has 90% success rate but gets half the rewards when it wins doesn't necessarily make more money than me. Actually, the opposite way around. And I could be sometimes wrong more than 50% of the time. It's just the way it goes. If I have 25% success rate on a risk-reward ratio above 5, I'm making more money than the other guy. And if you can process that in your head and comprehend how important that metric is in trading, because we're talking here about something radically different than just being right or wrong. We're talking about Sharpe ratios. To define $1 of profit, how much risk did you take? The best traders are not the ones that get the most success rate. The best traders are the ones that have the highest possible Sharpe ratio. That's it, guys. See you later.